So today we're going to talk about this powerful, invisible force that's pulling the strings on trillions of dollars in global markets. It's a story of, mind-blowing efficiency, but also pretty terrifying fragility.
And really, it all boils down to this one question. Because this isn't some made-up scenario, this actually happened. I'm talking about May 6th, 2010, the infamous flash crash. $1 trillion in market value just, poof, vanished. And then it reappeared in about the time it takes to make a coffee. Seriously, how is that even possible?
Well, the answer, and that ghost we mentioned, it lives inside the machine. This is all about the incredibly complex autonomous systems we've built to run our entire financial world. So let's dive in. Okay, so first up, we need to get our heads around the invisible architecture that's actually powering modern finance. We're talking about markets that are, for all intents and purposes, flying on autopilot.
And this right here is the key idea: algorithmic trading. Put simply, it's just using computers to make trading decisions automatically. The algorithm is the one calling the shots: when to buy, what price to pay, how much to trade, and it's doing all of this in the blink of an eye.
And this is the really crucial part. This isn't some niche sci-fi corner of the market anymore. No way. I mean, according to folks like the European Securities and Markets Authority, or ESMA, if you're a pro trader today, you are almost definitely using algorithms. And why? Well, because humans just can't keep up. We can't compete with the raw speed and data crunching power. Trading without a computer is now the exception, not the rule. You could say the machines have already taken over.
But, we've moved way beyond simple automation at this point. The trading brain itself has evolved. It's become something way more powerful and way more unpredictable. Just look at the leap we're talking about here. Your traditional algorithms, they were all about one thing: speed. Just following a bunch of static, pre-programmed rules as fast as possible. But AI-driven trading, man, that is a whole different beast. It's all about intelligence. It uses this thing called deep reinforcement learning, which lets it adapt in real time. The best way to think about it is like this: you're not giving a computer the rule book for a game. Instead, you're letting it play millions of times until it just figures out the winning strategy all by itself. So it's not just following orders anymore, it's learning. Now, this new AI trading brain, it comes with some absolutely incredible promises. I mean, for a lot of people, this is the key to creating a market that's faster, smarter, and, well, maybe even perfect. And these benefits aren't just theoretical. You can actually see them. AI trading pumps more liquidity into the system, which makes it easier for you to buy or sell whatever you want. It tightens those bid-ask spreads. That little gap between the buying and selling price? That means lower transaction costs for everybody, from huge hedge funds all the way down to you and me. And it makes prices super efficient because it's constantly hunting down and zapping tiny price differences between markets. That whole process is called arbitrage. And just to give you an idea of the scale we're talking about here, get this. The TAB Group estimated that just one single strategy, that high-speed arbitrage we just mentioned, generates over $21 billion a year in profits. This is not small change, folks. It is a massive wealth-generating engine built on pure speed and raw intelligence. But what happens when that engine misfires, right? We've seen the promise, the upside, the boom. Now it's time to look at the bust, the hidden dangers, the systemic risks that pop up when all the machines start thinking the same way. And this quote right here, it really gets to the heart of the problem. When things go wrong in this world, they go wrong faster than any human could possibly react. Once an error starts cascading through these interconnected systems, it's pretty much impossible to hit the brakes. And look, this isn't just a theory. We've seen it happen over and over. You had the big one, the 2010 flash crash. Then, in 2022, a fat finger error kicked off a nasty brief crash in the Nordic markets. And just this year, in 2024, automated bots spotted a simple typo in Lyft's earnings report and sent the stock rocketing up 67% based on totally wrong information. The point is, the machines react instantly, and they don't care if the info is right or wrong. So how does this kind of systemic risk actually build up? Well, research points to three big problems that all feed into each other. First, there's something called performative prediction. Basically, the AI's forecasts are so influential, they actually change the market, creating these bizarre self-fulfilling prophecies. Second, you've got algorithmic herding. Because so many AIs are trained on the same data, they all make the same decisions at the same time. It's like a digital stampede for the exit. And third, there's cognitive dependency. The more we rely on these machines, the rustier our own skills get, which means there's nobody left to grab the wheel if the AI suddenly fails. So, faced with this totally new reality, regulators around the world are scrambling. They're basically trying to write a new rulebook for a world that, frankly, they didn't build and don't fully control. One of the major players here is the European Securities and Markets Authority, or ESMA. They're really on the front lines, trying to build some guardrails for this high-speed, automated world. Trying to stop the next big crash before it even has a chance to start. And it really is a global effort. Over in the US, you've got the SEC cracking down on what they call AI washing. That's when firms lie about how good their AI is. In Europe, ESMA is all about governance and testing. And then you have groups like FINRA here in the States who are digging into the risks when firms use AI systems they bought from somebody else. Okay, so what does this all look like in practice? Well, regulators are demanding some really specific safety features. We're talking about things like pre-trade controls, sometimes called hard blocks, which automatically stop completely insane orders from ever going through. They're making firms do intense stress testing to prove their systems can handle huge spikes in trading. And then there are two really big ones. Explainability, you have to be able to explain why your AI made a certain decision, and accountability. The firm is on the hook, period. You can't just throw up your hands and blame the algorithm. But just as regulators are starting to get a handle on the AI of today, the technology is already leaping forward into a new and honestly even more complex space. The next frontier seems to be this fusion of AI with another game-changing technology, the blockchain. Let me put it this way. Right now, AI agents trade stocks and bonds on traditional exchanges like the NASDAQ. But tomorrow, we could see AI agents autonomously managing what are called tokenized assets, basically digital versions of real-world stuff like real estate or fine art. And they'll be doing it on global, decentralized blockchains. The trading floor of the future might not be on Wall Street at all. It might just be on-chain. And that brings us all the way back to our final big question. That ghost in the machine, it's getting smarter, it's getting faster, and it's getting more autonomous every single day. It offers these incredible rewards, but it also comes with these profound system-wide risks. So as we hand over more and more of our financial world to these AI systems, you really have to stop and ask, have we accidentally built a market that we can no longer control?